For more, let's bring in our featured guest, Lyle Stein, president of Forvest Global Wealth Management, here in studio. Great to see you, sir, as always.
Good morning, Mark.
Good morning. It's been a while. This will be fun. Lots to talk about.
Absolutely.
So how do you explain what's happening in the markets right now?
Well, we went through 2024 with great expectations of lower interest rates. You know, the beginning of the year, I think the markets were looking for 7 cuts. The Fed finally responded to those cuts in September by dropping the Fed funds rate by 50 basis points. But as that chart just showed, the day almost that they dropped, 10-year interest rates started to go up. And they've gone up by about a full percentage point since mid-September when the Fed did that cut. And markets are now getting a little bit nervous about what does that inflation number look like 2025 and 2026 as deficits are high. And also just the notion that inflation is going to continue to go down, that's coming off the table. So you've got greater uncertainty at a time when inflation expectations are rising, and that's got the market in a tizzy because as interest rates go up, as the cost of capital goes up, asset prices go down. And we're seeing it right across the board in equity markets in particular.
Right. And how would you compare this to 2022 when we saw interest rates rising and stock markets rolling over?
Well, it's very interesting. In 2024, it was almost the opposite of that. As interest rates rose, the stock market continued to rise because there was a great expectation of earnings, as well as the fact that the Magnificent Seven were driving pretty much everything. And so money flowed into the Magnificent Seven. But if you go back to 2022, when rates went up and stocks went down, it was the Magnificent Seven and growth names that got hurt quite badly.
So we hear the term bond vigilantes every now and then. Lately, we're hearing it more often that they're demanding higher returns, higher yields to account for these deficits and debts. So under President Trump, we know what happened the first term. Deficits and debt went up. They're talking a good game about cutting the deficit. Do you think they'll do that?
It's going to take a lot of work to get that down. Even Mr. Musk and Ramaswamy said last week that it's going to be tough to get it over $1 trillion. They'll have to work hard. But we don't really even know what that means. Is it $1 trillion off of $6 trillion of spending, or is it $1 trillion over 10 years? It's got to be defined better.
Right, exactly. Now, you point to the UK, and we don't talk about it that much, but the 10-year gilt, as they call it, the yield there is at a high not seen since 2008. What's happening in that country?
Well, that country, very much like Canada, is stagnating. You've seen a rise in interest rates. That's hurting their housing market. You've seen a slowdown in the economy, and you've seen global uncertainty with respect to the currency. And, you know, it could be UK, you could put Canada in there, you could put a bunch of other countries in there. One of the problems that the world is facing today is that the interest rate situation in the U.S. is what economists say crowding out other markets. Money flows to the U.S. It's the only safe place to be in many respects. And as their rates go up, rates around the rest of the world have to go up too. And we haven't seen that in Canada, and that gets quite interesting. Let's
not forget major North American equity indices hit all-time highs back in, I guess it was early December. We're not that far away from that. So is this a dire situation, or is this just a natural sort of correction in the marketplace?
Well, it's a tough one. I wish I had my crystal ball so clear. But I think what we're going through is a reset of expectations. The expectations that we had were that earnings are going to continue to grow by 10, 15%. And isn't that great? And the Magnificent Seven are going to continue to get all the money flows. That hypothesis is now being put to test. Whether it's something a little bit more tragic for equity markets, I think time will tell. But if rates hit 5%, I think all bets are off.
Right, so that's the key threshold, 5%. We've seen the 30-year go over 5 briefly.
Yep, and I think 5%, I mean, the global benchmark for investing, the risk-free rate globally is that U.S. 10-year bond, and 5% seems to be as good a number as any. You know, it could be 498, it could be 504, but I think crossing a 5% barrier will, put a bit of the fear of God in markets.
Just lastly here, before we take a break, 5%, could investors just sort of get used to higher rates? Because the U.S. economy seems fairly solid. And let's remember in the 90s, the rates generally were 5 to 7%, and everybody seemed okay with that.
Well, in fact, Paul and I have discussed this many times. For the last 5,000 years, the average interest rate is about 5%. 5% is not a bad number. Inflation 2 to 3, a real return or a term premium of 2 to 3. You add 2 and 3 together, you get 5. Not a bad